All right, time for the hot picks section of the program. You know, we were talking about in the recent rally for the TSX, investors seem to be getting excited about industrial stocks. So we wanted to zero in on some possible opportunities in the world of industrial investments. Maxim Sytchev, one of our regular guests, is managing director of industrial products at National Bank Financial. So the perfect person to talk to about a sector that is starting to get a lot more attention. Generally, what would you say if the market gets in a more positive mood? Why is the industrial sector one that gets people excited?
Well, first of all, it's more cyclical. So by extension, there's just a higher beta component. And to be honest, like if we were to go back 9 months ago and somebody would have told me how the stocks, how well they would have done over this time frame, I would have been surprised, especially given all sort of the geopolitical uncertainty. But the reality is that as OECD countries, and U.S. specifically, is trying to decouple from China, while also somewhat trying to decouple from the U.S., and all of these dynamics require more investment, whether it's supply chains, defense, roads. I mean, we had huge population growth in Canada, obviously, for the last decade. So it's basically just a catch-up dynamic, which is benefiting my entire cohort as we speak.
Okay, build, and these are the companies behind it. So let's go through a few examples. I want to start with Toromont, maybe a reminder of how the Toromont business is structured, and why you think it's a pretty good investment to take a look at.
Yeah, so we've been pretty tactical. So we downgraded the stock at 130 last year because I felt that the margin expectations were too high.
Okay.
Stock came down to 110 in December. We upgraded it. What Toromont provides as a service, they distribute Caterpillar equipment in Eastern Canada. So very old school business, obviously attached to a #1 OEM. The stock is only up 3% year to date, basically barely kind of matching the TSX. And what's interesting is that if you look at the budgets in Ontario and Quebec, very infrastructure friendly. So whether you look at high-speed rail between Quebec City and Toronto, I mean, this is going to be like gigantic investments in equipment. You look at Hydro-Quebec, what they're trying to do. So there's just a colossal amount of capital that will require horizontal infrastructure build-out for which you will need equipment. And so the stock is not super expensive. There's also a bit of a sexy part of the business, which potentially is getting right now into data center cooling, which we think could be a bit of a sleeper hit over the years. So we are, as I said, we upgraded at 110. It's trading right now at 116. And I do believe that there is more upside in the stock as we speak.
And when you're analyzing companies, obviously you're looking at the trends and the potential to win business, but I'm sure you're also looking at the balance sheet. I mean, are there things that you see there that you like as well? Oh,
100%. I mean, the company basically is in a net cash position. So, I mean, that's kind of as bulletproof as you can get from that perspective. And we'll see whether it's going to be potential M&A. They've done a couple of transactions recently, or, special distributions, NCIB. I mean, there's a plethora of things that they could be looking at, but that's the least of my concerns from a balance sheet perspective.
Okay, so let's move from distributing cat gear to steel distribution.
Yeah.
Russel Metals is another name that you're constructive on.
Very.
And everybody's talking about the trade. It gets very confusing.
Yeah.
But when you look at the business of Russel Metals, what do you see?
It's actually, this one, it's ironically a direct beneficiary of tariffs. So the reason why hot rolled coil and plate pricing, so these are the kind of the raw materials for steel, are rallying is because U.S. has tariffs around these commodities. So they're literally up 35% from December timeframe. So that means as a distributor, you're just passing through these costs onto your customers. So that's why the Q1 earnings for Russel were so robust because of that material increase pricing dynamic. And the interesting thing is that we actually haven't seen the peak of margin generation for them. It's going to come later as you are selling down kind of the expensive inventory and benefiting from future uptick. And also the company right now is integrating Samuel & Co. transaction, which they've done last year. So you have multiple layers of margin expansion, benefiting from much higher commodity pricing. Balance sheet is in a pristine shape. And because they're selling steel domestically, so 40% of their business is in the U.S., but they're sourcing steel from U.S. producers. So there's no cross-border movement at all. So you're trying to benefit actually from both sides of the story. It's North American pricing, so the fact that Canada could be potentially under pressure has nothing to do with actual company's business.
But if they did more deals, that could sort of be a steady additive.
Absolutely, 100%. Yeah, and the balance sheet is completely clean. So the optionality to do M&A is huge. It's super cheap. It's trading at 10 times PE, 4% dividend yield. Again, for me, it's a no-brainer. And the stock is flat year to date, which it shouldn't be. It should be much higher.
Interesting. And then the third name you brought to our attention today, I'm sure regular viewers will be familiar with Stantec, STN.
Yeah.
Walk us through the Stantec story.
Yeah, continue to love it. It's my best idea in the engineering consulting space. That was the case in the beginning of the year. The stock is up 25% year to date, so doing extremely well. The big concern was around their U.S. exposure, which is 55% of revenue. And as you might recall, the DOGE, news flow, sort of all these things, the federal government exposure for Stantec is very limited. And we have seen in Q1 earnings very strong organic growth overall, 6%. What's really exciting for us is that that's the company which is going to be able to do more M&A, and we think of greater size relative to its history. Balance sheet is super clean, and that's my high conviction double, obviously including that 25% year to date over the next 3 to 4 years, because all the trends that the company is witnessing right now are extremely positive.
We're almost out of time, but having spoken to the head of Atkins Realis, your comments about Stantec, we know that WSP, here are 3 companies that have been very bold and aggressive and acquisitive.
Very.
So that's a trend to watch over the long term,
Yeah,
you think?
absolutely, yeah, 100%. I mean, WSP is the largest engineering company in the world. Atkins obviously has a nuclear component, which is very exciting right now for investors. Sure. And, Stantec is, this very kind of steady eddy with a potentially aggressive M&A ahead of them. So, very excited about the space, to be honest.
Maxim, thanks for joining us for Hot Picks. Maxim Sytchev joining us from National Bank Financial. By the way, market call today, Darren Sissons.